You are now about to witness the strength of William Gann. Let us now focus on his 1929 forecast, and we will then go to his 1935 and 1936 forecast. These are from his original documents, and I am in possession of these. This is starting on page 9, and we will start with the 1929 forecast. According to my discovery of the 60-year cycle, I had figured that the 1929 would repeat like 1869, 1909, and 1919. Looking back 20 years, we find that the top was reached in August 1909, and 60 years before, the top was reached in July 1869. If you will read my annual forecast for 1929, you will see that I had figured the top must come no later than the end of August, and stated that a Black Friday would come in September, following strictly the 1869 top. The top would have come in July 1929, and some stocks did make top at that time. Following the 1909 top, we could expect top in August, and the actual high of the averages and many individual stocks was reached on September 3rd, 1929. Going back to 1919, we find that the averages made first top in July, and a big decline followed. But extreme high was made in the early part of November. From all of these tops, 1869, 1909, and 1919, sharp declines followed in the fall of the year, just as they did in 1929. Therefore, you see how easily it was to follow the great advance and determine when it would culminate. Therefore, it is no other way outside of using the 20 and 60-year cycles that we could have found or forecast this great bull campaign and its culmination so closely in 1929. 1869 to 73 versus 1929 to 1933. After the 1869 top, stocks continued to decline and reached low in November 1873. See how many other bottoms were reached around this time in other cycles. After the big decline from 1929, notice that in October 1933, the last low was reached on the Dow Jones averages, then followed and advanced to new high levels, crossing the top of July 1933. Next, we look at the 1935 forecast. Figuring out the forecast for 1935, we see on the 20-year chart that we are running against 1855, 1875, 1895, and 1915. Therefore, we look to see what happened in those years. We find that in 1895, the high was reached in September in 1915. The high of the year was reached in December. Then, look back at 1865, 1885, 1905, and 1925, the years in the fifth zone of the 10-year cycles. We find that in 1865, the high was reached in October. In 1905, the high was reached in October. In 1925, the high was reached in November. Then we would have a good rule and guide in making up the forecast for 1935 and would know what months to watch for top and a change in trend. My annual forecast for 1935, which was made up in October 1934, indicated top for October 28th and the secondary top for November 15th and 16th, 1935. There are other ways of using this chart to advantage. One method of determining the trend is to compare the years of previous cycles in the same zones. For example, after the Dow Jones 30 industrial averages crossed 108 in May 1935, they were above the average high price of all the previous years in the 15th year zone. Therefore, the market indicated higher prices and showed that there would be a bull campaign. Next, we will look at the 1936 forecast. If we wish to make up a forecast for the year 1936, we compare the years in the 16th year zone. Visualize 1856, 1876, 1896, and 1916, as 60 years back is a very important cycle. We look at 1878 first, then 1896, and then 1916. 60-year cycle, 1876. We find that the averages run up and reached high in March, then a decline to the end of the year. The 40-year cycle, 1896. Next, we look at 1896, which is 40 years back, or two 20-year cycles. A very important presidential election year, just as 1936 will be. We find that there were a moderate rally into February, a decline to March, then a small rally to May, from which a panicky decline followed, culminating on August 8th, 1896, with the averages at the lowest levels in years. From that point, a bull campaign started, with prices working higher to December. 20-year. The next important cycle is a 20-year cycle. 20 years later, or 1916, we find that prices declined in January, rallied moderately in February, then declined sharply to April, rallied to June, then declined and made bottom in July, from which a big bull campaign started, making top in November 1916 in a war market. A panicky decline followed from the latter part of November into December. This completes our comparison of the 60, 40, and 20-year cycles back from 1936. Next, we look up the cycles on the other side of the chart in the 6th year of the 20-year cycle, or the 6th zone in the 10-year cycles. Those years are 1866, 1886, 1906, and 1926. 70-year cycle. We find that in 1866 there was a sharp decline, reaching bottom in February. Then an advance with a top of the year in October. 50-year. We find a sharp decline in bottom in January, a moderate rally into March, then a sharp decline to now lows in May, a sharp advance reaching high in November, and a sharp decline in December. 30 year, 1906. The next important cycle to consider is 1906. In that year, the Great McKinley boom, which began in 1896, culminated. The railroad averages reached the highest price in history up to that time. From the high of January, a sharp decline followed. To May, much of the selling was caused by the San Francisco earthquake. Then there was a rally into June, followed by a sharp decline to low in July, with the bottom just slightly higher than the low of May. From this low, there was an advance to September, when another top was made, but lower than the top in January. Then followed a decline into December, and a panic followed in 1907. The 10-year cycle, 1926. The next important 10-year cycle to consider is 1926, when the Great Coolidge bull campaign was underway. From the low in December 1925, stocks rallied to February 1926, then had a sharp decline to March, some stocks breaking as much as 100 points. From this bottom, there was a sharp advance to new highs, reaching top in August, then another sharp decline to bottom in October, from which a rally followed to December, but stocks did not get back to the highs reached in August that year. Now, when I get ready to make up my forecast for 1936, I will consider all of these cycles. I will go back and also check the 7-year cycles, the 14-year and 15-year cycles, which is half of the 30-year cycle. But at this writing, with my knowledge and experience of the future cycles, I expect the 1896 cycle to repeat in 1936. 1936 is likely to be a very uncertain election year, just as it was in 1896, when the Brian Silver scare caused a panicky decline into August. There is a possibility of a three-cornered fight with two Democratic presidential candidates and one Republican. There certainly is going to be a time during 1936 when the investors are going to get scared and speculators are going to get scared and sell stocks, causing sharp declines. My opinion at this writing is that the first decline will start in the month of January and wind up with a sharp decline. February, the market may drift along in a narrow trading range with some rallies, but there will be another decline in the month of March, just as there was in 1926. I am confident that there will be another break in the months of May and June, especially in the latter half of May, as this will be running out 4 years from the 1932 low and 6 years from the April 1930 high, all of which are indications of important changes in trend. We know that presidential nominations will take place in July. Therefore, this is a month to watch for uncertainties and declines. Unless sharp declines have come before that time. The ending of this cycle from 1896 in August is quite important. And regardless of how high or how low stocks are, there are likely to be very sharp declines before the end of August. Again, in the last half of September, uncertain conditions and possibility of sharp declines are indicated. This may mark the last low of an election rally and may start if there are indications of a change in administration by the election of the Republican president, which I believe at this writing will happen. September, October, and November are all important because these months are 7 years from the top in September 1929 and 7 years from the panicky decline in October and November 1929. I would expect a rally to take place after the election in November, which would last anywhere until the end or early part of December. If conditions show signs of improvement and if the people are satisfied with the man elected, then the advance will probably continue into December with high prices around the end of the year. This is merely a general outline that I am giving without completing all of my calculations and making up the annual forecast in detail.